To set the stage for discussion, we have an insightful keynote by Mr. Rahul Khanna, co-founder and managing partner at Trifecta Capital. To give you a brief about Mr. Khanna, he has co-founded Trifecta Capital in 2014, positioning it as a key financial partner for leading startups. With 26 years of experience in investing and operations across sectors like technology, media, and telecom, he has been instrumental in shaping India's venture capital ecosystem since the mid-2000s. Mr. Khanna, I'll leave the stage to you.
You're a week after that fantastic lunch that we just had. I'll try to make sure that you guys don't fall asleep because we've got a pretty action-packed schedule for the rest of the day. Thanks a lot for the organizers for inviting us to speak. In a way, we've been part of this ecosystem, but we're probably the largest impact fund you hadn't heard of so far. And I'll come to that in a little while. Just by way of capital deployed, we've been a very active participant in the impact ecosystem. And I think increasingly as the world of impact investing and say commercial investing converge, we're finding us being drawn into the sector even more. So I'll touch a little about the journey of Trifecta and then venture debt as an asset class, and then hopefully things that we can do more meaningfully in this space. So just really quickly, in terms of a vision, we want to be a life cycle partner to the best of the new economy. We want to improve access to different forms of capital. We want to enable various kinds of investors to participate in the India growth story. We want to promote collaboration between the old economy and the new economy. The fact is that India has a large base of family-owned and operated companies that aren't going away, so we want to be a bridge between them. And then, of course, we'd like to build a category-leading asset management platform. In terms of life cycle partner, we do both debt and equity. So at the early stage of a company, we provide debt. At growth stages, we provide equity, and hopefully we can be relevant through the journey. In terms of alternative capital, when we started in 2015, there was no venture debt fund. So we helped create an asset class, which has now become $1 billion a year of capital deployed. In terms of investors participating, many of our LPs are Indian institutions, banks, insurance companies, endowments that didn't invest in the venture asset class. So they've come on board and are now writing checks to many other GPs. And then, of course, collaboration between old and new. Many of our investors are large legacy family-owned businesses that now have family offices and want to participate in this ecosystem. We did about 7,500 crores under the Trifecta umbrella in the last 9 years across our debt and equity funds. Of course, our venture debt business is a lot more mature. We're on Fund 4 now, and we've done one growth equity fund so far. I think just in terms of venture debt, maybe I'll just clarify because not everyone may be familiar with the asset class or the product. So think about it as debt to venture capital-backed companies, right? Now, why do these companies need debt if they can raise equity? The honest answer is that the use of proceeds are better funded by debt than equity. So if you're funding consumer acquisition or burn, you should use equity to fund that. But if you're funding inventory, working capital, deposits, leasehold, for example, all these Zepto stores that are opening up, we're actually funding the capex that's involved in fitting out those dark stores, for example. Or all these fleets that deliver stuff to your home, which are powered by EVs, we're financing those fleet companies. We're also financing the companies that lend them money to buy those fleets, right? So in a way, we are funding working capital, we're funding asset purchases. We have situations where companies are making acquisitions, so we're funding that. And then, of course, we're extending runway because instead of having $10, you might have 15, including our money. So there's a range of reasons that companies take our money. Equally importantly, from a founder's perspective, our capital is largely non-dilutive. So every time you raise equity, you give up ownership. When you raise venture debt, you give up a very small amount of ownership, and the rest of it is just debt that you can service. So it's non-dilutive growth capital. And I think in a way, what started out sort of as a very boutique asset class and industry, today every round that you see typically after Series B, there's an element of equity and debt in that, right? And so this ecosystem has matured. This is in a strange way a different version of blended finance. You've been hearing the term blended finance. In a way that talks to the supply side of capital because you've got people coming in at different levels of risk. we structure our deals as a blended finance arrangement. So we have a debt instrument and an equity instrument. The debt instrument is senior secured, and the equity instrument gives us the upside. Right? So in a way, this is a blended finance, but as it relates to the borrower of the instrument. I touched on this a little bit, but typically, typically the coupons that companies service to us is anywhere between 13 and 15%. So that gives us sort of an assured return, provided the companies are around. And then we have these equity instruments, which provide us upside. Typically, that would add anywhere from 3 to 5% IRR beyond what we would make on the debt. So historically, we've seen that in a company that performs really well, we easily beat a 20% IRR on the return. And in companies that don't perform as well, maybe we just make our debt returns. Right? So this is a product that in the past largely went into verticals that may not have been as impact oriented. So for example, one can argue whether horizontal e-commerce has impact or not. There are second order effects in terms of delivery, logistics. But increasingly the world of, and the sectors like healthcare or education or agri, clearly have impact goals and outcomes, and we're finding that to be a lot larger in terms of our overall portfolio construction. So just in terms of our impact investments, everyone in the room is here because we believe in impact. In a way, we have been a private credit provider to the impact ecosystem. Of course, there have been people who come before us who have done some amazing work in, say, microfinance and financial inclusion, lending to microfinance companies. So that was in a way a vertical solution. Think about what we're trying to do as a horizontal application of credit across multiple vertical streams. Just to give you some numbers, so of the total capital deployed so far as a firm, on the debt side, it's been about 6,500 crores. About 3,000 crores has gone into companies that would be classified as companies in the impact space, typically either by IIC classification, or the equity investor is an impact fund. Right? So going back to my first point is we're amongst the largest impact funds you've never heard of, and Jasjeet came up with that phrase. But 3,000 crores in this category of broadly impact is a substantial amount of capital. So I think we played a role of additionality. I think now there is a lot more signaling value, saying, look, once we've allocated capital to a sector, into a company, other sets of debt providers start to look at it a lot more keenly. And we found that some of that comes from our investors, banks, NBFCs, and then from other credit funds and other credit platforms. Right? So there's a catalyst role, and then there's just the role that by way of serving a very large gap, we've created an ecosystem of credit providers now that want to go after this market as well. So the other thing we're seeing is that with time, the percentage of our capital that's going into this sector is going up significantly. So in Fund 1, about 450 crores went into the impact space. In Fund 2, it was 1,300 crores. Fund 3, it's already 1,200, and it's likely to end up closer to 2,000 crores. So that's a lot of capital that we're putting out the door. And I think in a way, the world of doing good and making money don't have to be at odds. I think that's my other message, that impact is also moving to a stage where commercial returns are equally possible. And for some of you in the previous discussion, some of these businesses have moved from concept stage to execution, and then from execution they'll get to an exit event, and then the cycle will only continue from there. Just in terms of our logos, we kind of think about our impact portfolio in these 5 buckets: in climate, in agri, in financial inclusion, healthcare, and other impact sectors. So some of these logos you may know, some of them are household names, many of them are well-funded as well from an equity standpoint. And in many cases, Trifecta was the first ever provider of credit to them. And so this is the point I was making, that the world of venture debt, which used to be sort of very startup-y, very niche, very boutique-y, and maybe not seen as relevant in the impact sector, I think those lines are getting blurred. Just from a number standpoint, we're seeing it in our own portfolio. And so I think with every successive vintage, the sectors that are drawing in equity capital, agri, healthcare, education, we're now hearing a lot about manufacturing 2.0, the India plus one story, next generation manufacturing, materials, a lot of that is now happening in India. And so naturally that becomes part of what we would allocate capital to. And then just in terms of, climate, because that seems to be a place where the convergence has happened the soonest, because you can think about climate as a horizontal, or you can think about it as a vertical opportunity. For us, we find that the whole EV value chain, batteries, charging, OEMs, financing of these companies has already become a meaningfully large space for us, and we've allocated about 500 crores already into about a dozen odd companies in that space. So, from a here and now perspective, it feels like the most meaningful intervention we can provide is within the climate space, and within that this energy transition. We aren't necessarily, we haven't done enough, and I would say we've looked at a few things like rooftop solar and some of the stuff that's on the hydrogen side we're starting to look at. But I would say the most real application of what we've seen in terms of our climate focus is the entire EV value chain. And then of course, the nice thing about that is it's very measurable. So in terms of just, CO2 abatement, etc., these are very measurable outcomes for us, and that also draws in a set of investors who are saying, look, great that you're doing all this work, but we'd love to see, the outcomes and measure those outcomes. So just by way of the investments that we already have, there's a meaningful amount of impact we're seeing on the CO2 side. So I'll stop there. The idea here was just to introduce you to the asset class and a little bit of work that we've done. I'm happy to take any questions. We have maybe 2-3 minutes, so if there's any particular questions you have, I'm happy to answer them. No questions? Please.
Sorry, I'm going to ask you
Yeah.
something related to EV only.
Yes.
The EV adoption on the ground, B2C or the B2B2C segment is almost 92%.
Yeah.
But the willingness to lend to that segment, given that they are gig guys,
Yeah.
and also on top of that, the rates that even those 8% guys are getting,
Yeah.
exorbitant, 18,
Yeah.
19%. I was at the GCF, those guys are getting money at 4 to 5%.
Yeah.
Is there anyone doing something? Have you looked at some opportunities?
No, it's a good point. Look, I think there's a few challenges around financing in the pure EV space. Both, two-wheeler dynamics are different from four-wheeler dynamics. Even the borrower profile, whether it is a corporate buying a fleet versus individuals buying a fleet. So I think the challenge that we're seeing right now on the four-wheeler side is really as it relates to residual value calculation. I think in the past it was easy to underwrite an asset because you knew that you could get certain residual value, and therefore you could price that risk more meaningfully. Today, for a lot of the larger four-wheeler, whether it's buses, cars, etc., the residual value and the life of the battery is not fully understood, and so people are unable to underwrite that the way they would an ICE engine, right? So there's a lot of buffering that's being done. Now there's a bunch of specialized EV lenders that have showed up, that have said, listen, we think we know we can track battery degradation, we can track the residual value, are we even willing to underwrite that? So on the four-wheeler side, we're seeing some activity with terms of specialty lenders showing up, and we've been providing balance sheet to them because they have a hard time borrowing as well. In terms of lending to the end borrower, in terms of two-wheeler, I think that is a bigger challenge because this is a movable asset, and so unfortunately you're still pricing the risk on the person and not the asset, right? And especially if that person is a gig worker and the bike is owned by him or her and not a corporate entity, then tracking the asset down becomes very challenging. So unfortunately, if it's a solo borrower, then his or her credit profile becomes the bottleneck, not the asset. So I think, if you look at the journey on, say, commercial vehicle financing for ICE, I think on the four-wheeler side, we're a few years behind that. On the two-wheeler side, I think the dynamics are a little bit different because the OEMs are also an evolving lot of people. right? You've got a bunch of new brands. Some of those machines haven't even been on the road for more than 2 years. So, it's a very messy space. So I think what we're trying to do is to say, okay, there are specialized lenders, two-wheeler, four-wheeler, they have a certain amount of expertise. We're not equipped to do that. Let us provide them some catalytic capital, let them show the model working, and then hopefully the guys who lend at much lower rates will follow us. It's a little bit like what we did in fintech. Fintech companies ideally should be able to borrow at much lower rates because the risks, once they're understood, can be priced. But we would provide the FLDG to these companies and they would then borrow from an NBFC or a bank. So we became like a credit enhancement layer and they didn't need to lock up equity when they went to borrow from a bank.
Just a follow-up point
Yeah.
on that. Actually, in that space, market has actually learned that this is a problem.
Yeah,
So demand generators are ready to buy assets
yes,
so that angle counterparty risk can go.
yeah,
And then of course, they are taking risk on vehicles which do not have batteries, so they want to go with that structure where there's a battery swapping angle
Yes.
involved because the uptime is also high.
yeah,
But then there also the lending by some of the names
yeah,
in that space is still happening to that 18-19%.
Yeah.
That transmission or that risk coverage is still not coming down. So
yeah.
that's-
Look, I would say that it's a fast-moving space. If you look at where we were 3 years ago in this ecosystem to where we are today, it's a marked change, right? There was a lot of skepticism. Will people adopt? Total cost of ownership? Are there real economic benefits of going green? I think those answers are much clearer now. So there will be a lag effect, but we're putting a lot of energy behind it. We're trying to educate our investors who happen to be larger financial institutions. Some of these guys are offshore. They're trying to find the right structure because maybe we won't get it from domestic sources, but let's say large Japanese institutions may want to come in and support this. But we need to be able to solve the structuring aspect. So I'd say it's a problem statement that we acknowledge. We've started to make a little bit of a dent in it. Hopefully we can just pour a lot more money behind it at rates that are commensurate with the risk, right? I think the challenge is if the risk truly demands 24% and we do it at 12, then somebody else needs to carry that 12. Because the commercial investor is saying, look, the risk is 24%. Okay, cool. Thank you very much.